Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
A very warm welcome to all of you to Season 2 of This Week in Intelligent Investing. It's wonderful to be back. We have a terrific season ahead. We will also be hosting some wonderful guests as we go along. But I am just so excited to welcome today my co-hosts, Elliot Turner and Phil Ordway. Great to have you here, guys. Let's get right into it. I'll turn it to Phil.
Thanks, John. It's great to be back. It seems like it was a lot longer than a few weeks. So I'm glad to be back and get back to our normal routine. So, yeah, over the past few weeks, I think like a lot of people, I took some time away. We had a couple of family trips. So it was kind of nice to unplug in that regard and get away from the usual work routine. And one of the things I was thinking about while we had some of those lazy days of summer was why, when I did re-engage, like at the end of the day or sometimes after a few days and just sort of glance through what was going on in the world, it was really stark to me how and it's been going on for a long time, obviously, but seemingly all news is good news when it comes to security prices. And it just sort of, that little bit of detached perspective got me thinking more about market cycles and feedback loops and everything that's been going on in the world, because it's really easy. I think lately it's been pretty easy to look at what's going on in the world and just assume that it would be bad, right? I mean, if you take just the last 18 months, and again, talk about something that feels longer than what it's actually been. I mean, the last 18 months feels like it's been 7 or 8 years, but you've obviously had the COVID-19 pandemic, which has completely reshaped the world in ways that I think we still don't really understand. We've had massive amounts, particularly in the U.S., or at least in the U.S., massive amounts of social unrest, extreme political dysfunction, a lost generation or a lost couple of years at least at school for many children, a plunge in the labor participation rate, a massive explosion in fiscal deficits. Interest rates have continued to be kind of defying what a lot of people think they should be doing. You've got a plunge in birth rate. I mean, just lots of things that I don't think portend well for the next, say, 5 to 10 years and possibly for a generation or more, right? I mean, when you look at labor participation rates, you think about people that have dropped out of the workforce, those are people that we would need to drive the economy forward for the next 10, 20 years. And we're not just going to bring them all back overnight or even in a month or a year or sometimes not even in a decade. So none of that seems to be positive, right? And there are offsetting positives, right? It could have been, I'm still shocked, frankly, that the fallout from the pandemic wasn't worse. I'm shocked at how well the combination of transfer payments and fiscal and monetary stimulus worked. Certainly the advent of certain technological tools, everything from information technology abilities to track and manage inventory and manage supply chain disruptions has been a huge boon and certainly dampened the traditional business cycle and inventory problems. As bad as they've been, they could have been far, far worse. And certainly things like the mRNA platforms that are the foundation of many of the modern vaccines that are muting the effects of the pandemic that could be so much worse. So I'm usually a glass half full kind of guy, right? I mean, if somebody asked me to describe my outlook on most things, I think it would normally be that I consider myself and aspire to be and try to consciously push myself toward being a rational optimist, right? I mean, there's no sense in being starry-eyed and naive and overly optimistic, but likewise, I don't really ever fall into the trap of the pessimism that kind of sells. I think it's a great way to market investment funds and get lots of news clicks and eyeballs is to be overly pessimistic and constantly decry all the things that are going wrong in the world. So I'm not trying to do that either, but it does kind of stand out to me, right? I mean, market cycles just seem to have been truncated and shrunk down so much more, even in just my relatively brief career. I mean, if you think back to prior generational disruptions, you wouldn't have had whatever it was, I think it was 164 days last year between, the fastest ever decline in market prices. I think we were down 34%. in the S&P 500 in a couple of weeks, and then right back to all-time new highs 164 days later. It was something like that. Those numbers might be slightly off. But, things like the Great Depression or major wars or just asset bubbles that needed to be popped, those things generally always took a couple of years to play themselves out, right? And there was always kind of this pull and push between a 2 to 3 year rebalancing of the business cycle and these longer kind of 15 to 20 year waves in both fundamentals and demographics and sentiment. They're all combining in weird ways. And that just seems to have been kind of thrown out the window. I mean, I read back into history as to what it was like for investors when, the market basically went nowhere from the late 60s to 1982. I mean, that kind of stuff, right? Where you're just trading in these relatively narrow bands for a long period of time. And people have tried to call that type of environment again. It just hasn't happened, right? I mean, we've just kind of been on this relentlessly optimistic march as it comes to security prices. And so John actually sent around, I don't know, Francois Sicart, I hope I'm pronouncing his name correctly. But he's got a blog through his firm, and John sent this around. And there's an interesting essay called "Nostalgia Isn't What It Used to Be," which he admits is just kind of a title he'd been trying to find a use for. But it came out about a week ago. The point of it was talking about looking back at like Paul Volcker and the inflation war that he was fighting. This was from an essay, or it was an essay adapted from a speech he gave in 1978 when he was still president of the New York Fed before he was chairman of the Federal Reserve. And, he was extremely consumed with inflation, but he was also consumed with this idea of complacency and the fact that, economists were convinced that they had sort of eliminated the post-war cyclicality that they'd always kind of seen in the world, or really even the pre-war cyclicality they'd seen. And these counter-cyclical policies that economists had conjured up had really conquered the business cycle. And the essay goes on to point out a lot of really valuable things about how inherently in just about any system, stability leads towards instability. And the vagaries of human behavior and psychology lead to lots of unpredictable things. And I think that's where we ought to be standing today. And instead, I look around and see all this chaos and frankly, entropy in the world and don't see that reflected in a lot of security prices. But that doesn't mean there's an obvious answer to it. So this is where I'm going to be looking to you guys to chime in as to what to do about it. And maybe there's still not a clear answer. There almost certainly isn't a clear answer. But one framework that I liked in this essay was VUCA: volatility, uncertainty, complexity, and ambiguity. So volatility, uncertainty, complexity, ambiguity. And that was drawn from the U.S. Army War College as an acronym they created for the post-Cold War world planning scenarios that they'd run, where they had sort of always operated under one scenario, right, which was the U.S. engaged in the Cold War, and then all of a sudden, really overnight, in one sense, like the Cold War kind of appeared to be over, and now what do, right? So you have all these like uncertainties swirling around, volatility and ambiguity and complexity, and all these issues to deal with. And I thought those were 4 really good things to keep focused on, and so. I don't know. I mean, what comes next? I think the answer is who knows. But I think the one thing to focus on right now is that confidence and complacency seem like the mantra and the zeitgeist right now for many, many people. And it just seems like no matter which way you turn in business, particularly in securities markets in the investment world, we're just, those are the prevailing things of the day. And so I don't know what to do about it other than to stick to my knitting and hold cash and be willing to look like an idiot for as long as it takes to ride this out. So what do you guys think? I mean, have cycles really been shortened up, I guess is one answer, right? I mean, do you really think that now when bad things happen and markets kind of fall out of bed, you have days and maybe a few weeks instead of months and a few years for that to be processed and taken advantage of? Or is that overstating it? And then secondarily, do you agree with my assessment on where we stand today in terms of confidence and complacency?
Yeah, I think you raise a lot of good questions there, not just the 2 you ended off with. But, I do think there's been this swifter response from policymakers with more force than has been the case in the past. And part of that is the development of a new toolkit during the financial crisis, where in some ways, the response started slower than it should have and then got to be quite aggressive. And so, every time something seems to be happening, there's the sign that there's going to be more support and help. And therefore, people come back in with force once that's clear. I think, that quote you had about stability leads to instability, I'm pretty sure that could be attributed to Hyman Minsky, though, that probably exists in other contexts too. And, I think during the crisis, I got really, I read just about everything I could from Minsky, and I'd say I became a self-described Minskyite and view his framework as kind of the greatest fusion of Austrian and, call it freshwater and saltwater economics that I've seen. Like the way he fused the financialization of the economy with these Keynesian principles of having to support demand when demand falls short, because the underlying kind of edifice of the entire monetary side of the economy could fall apart is quite profound and interesting. And, he was he was very insistent that over complacency is actually what creates the conditions for economies to fall off. You end up with what he called Ponzi underwriting standards across the economy, not to be confused with Ponzi scheme per se, but it was a distinct allusion to that. And so, that's definitely a problem. But, I would come at this from a different angle. When we were taking our break, I wrote my most recent letter, and I compared what COVID's done to the economy with what, I'm a fish fan. I've spoken about this before. They have this thing called type 1 or type 2 jamming. So I don't know if all of you are familiar with the band Fish. If not, brief background is they play songs and improvise around them. So type 1 jamming would be taking a core structure of a song and noodling around a structure without leaving it. But type 2 is saying, you start a song and then you end up in a completely different space that effectively has no tether to where you started at all, and structure is left entirely. And the way I see it with COVID, we've left structure as a society in the biggest, most profound way that we've experienced since World War II. And I love those phrases that you gave from the post-Cold War planning of risk, uncertainty, complexity, ambiguity. Did I miss the first one? I might have gotten the first one wrong there.
Volatility.
Yeah, volatility. That's right. Volatility, uncertainty, complexity, ambiguity. And I think that's fantastic. I think it's so apt. And it makes me think a lot about jamming and music. In Fish, there's also, they compose their songs based on tension release, where you build up these periods of intense tension and then release it. And one of the things about type 2 jamming, where you leave structure, is that both risk and reward are greatest. The worst moments and the best moments tend to happen in those. And so that's not to say there's something that's fundamentally good about COVID in the end, but leaving structure creates interesting things in the theoretical sense. And it gives opportunity to try things that otherwise could not have been tried. And when you do that, it opens doors that make new things possible. But it also, the other side of that is it increases risk tremendously, especially when you're coming out of a period of rising social tension. So it's unclear exactly how that's going to resolve. But I feel like what may be interpreted as complacency today is actually a period of rising tension without having experienced the release, and we don't know which way that's going to go. And there are signs that it could go in either direction. But by and large, I do think there's some pretty constructive underlying forces in certain areas of the economy, certain areas of just think about one thing where right now, while I was away, I was up in Lake Placid, and literally every place I went to had a help wanted sign. A couple of our favorite restaurants, we've been going there for 6 years now, couldn't even open on some days because they can't hire enough staff. That's a bad thing in the short run. It definitely crimps supply, and you hear about supply shortages in a lot of industries. But on the other hand, there's a lot of demand, and there's a lot of, people getting jobs who had harder times in the past. And part of it is there's a friction in moving people from maybe brick and mortar and, more traditional, tied to physical location jobs to ones that are physical but help the digital world. So there's definitely a friction in getting people to new places. But some of these forces could be quite strong and could be really helpful and could lead to much better outcomes down the line. We just don't know how it's all going to play out yet. So I don't know if it's really complacency. I feel a lot of tension. I see tension. You could just see it in some of these like town halls about mask policies. And, I think that's stepping outside of the economic sphere. I know you're asking something a little different, Phil, but so maybe it's complacency in underwriting standards, but, I think this tension is the sign that something's going to be released. And, I think about it from that angle.
Well, I agree that it's a paradox, right? Because you're right. There's a ton of underlying tension in just about every facet of life these days, economic and capital markets life included. But the complacency I was talking about was more just this pervasive belief that the Fed always has your back. Asset prices only go up. Every dip is a buying opportunity. Nothing's ever overvalued, right? I mean, I think when Dave Portnoy of Barstool Sports is like a leading authority for tens or hundreds of thousands of people risking real money in the securities markets every day, and his mantra is very simple. It's that stocks only go up, right? I mean, that's the kind of complacency I'm talking about. I think across the whole market in almost every asset class, I think that's generally true, that the optimism is pretty well baked in and crowding out any of the pessimism. So that's the complacency. And I agree. I think it's a really weird time because you're right. There is a lot of underlying tension otherwise. And there are some underlying positives in the economy, like I mentioned. I mean, you can put a positive spin on it, as you just did, with the fact that, labor participation has plunged and millions of people are still out of work who should otherwise be employed. And there's a great mismatch right now between job openings and job applicants. And that over time could be somewhat of a net positive. I kind of see that a little bit as a net negative, right? I mean, I don't think you don't want that structural mismatch to last too long, right? Would be the concern I'd have. But I agree. I mean, it's weird, and it is hard to kind of diagnose it in short order. That's for sure.
Yeah, Phil, I definitely agree that just given the run-up we've had in the market, that there's not much fear out there right now. So whether you call it complacency or enthusiasm, definitely news tends to be interpreted bullishly, that otherwise might not be. If the economy is strong, that's a bullish sign. If the economy is weak, that's also bullish, because that means the Fed can remain dovish and we're going to have low interest rates, and that means valuations can be higher. So any way you cut it, people are finding ways to interpret the news positively, except maybe for what's been going on with some of the kind of big internet companies in China, where I think people are kind of revising their sentiment a little bit. But when you look at what's happened with SPACs, with IPOs, just generally running at record levels, the Goldman Sachs money losing companies index and how that's done, we're clearly closer to an enthusiastic level in the market than the opposite. And I think, a big question for me is what is that interplay between the online world and the offline world, really? I don't think we fully understand that. That's also where the inflation debate comes in, because if everything's moved online, that's deflationary. If we're not really interested in real goods, then clearly there's not going to be inflation. Anecdotally for me, I don't really see that people consume less stuff because they spend more time online. I mean, I find that in my family, we order quite a lot of actual goods that need to be made and shipped. And maybe even more so because you're online and you see things and you want things and so forth. So, but that's really the unresolved question in my mind, that we've had the Fed just be so aggressive and accommodative, and you could say, massive money printing if you want, but there haven't been consequences to date. And it's kind of, is it too good to be true, or is there a new paradigm? And I think once that gets resolved one way or the other, I think then we're going to see a big move in the market one way or the other.
Yeah, I think that's a good way of putting it. That's kind of what I'm thinking about. It's like, is there a new paradigm here, or have we really found some better, higher level of existence, right? Because to your point, I mean, it's not that there's some deterministic future and one truth that anyone can divine at a given point. I mean, a huge believer that just because history went one direction doesn't mean other things weren't possible, right? There's not just one path that's preordained here. And I think that's part of the complacency argument that I'm making, is that because things have worked out so well, and a lot of the things that could have gone wrong didn't go wrong, that people are acting like, well, of course it had to work out this way. Like that was all in the cards and nothing bad can ever happen. And that's where it's at. And like, yeah, I get it. Like there's not, a lot of the air has come out of the SPAC balloon, at least to a certain degree. But, I mean, there's just so much rampant speculation in that market still, and so many valuations of all sorts of things that don't make any sense. And I think the attitude that persists isn't like, boy, that was so stupid, I can't believe I gambled on this thing. It was like, oh, yeah, that didn't really work out, but I'm going to keep going to the casino. It would be kind of my diagnosis of the overall atmosphere. And so, look, I don't have any strong advice or prescriptions or answers for any of this kind of stuff, other than I think it's epistemically true that volatility is inevitable and that instability is a result of stability over time in any sort of system like the markets that we're operating in. So I think it just behooves people to be, not to go to all cash or gold or hide it under your mattress or anything like that. I'm not saying anything even close to that, but I think this VUCA, kind of mantra that came out of geopolitical planning post Cold War is a good way of thinking about it. So I'll leave it at that.
Well, one thing I've been thinking about a lot, which is kind of similar, but a little different, is it even appropriate right now to speak of just the stock market? Because coming out of the financial crisis, for the next 10 years, we had way higher than average correlations amongst and between stocks, both in sectors and between sectors. And since COVID started, there's been tremendous dispersion. Obviously, I'm not talking about the crash itself, because that was just a unique event. But coming out of that, the first trade was this basket of winners, and then was the vaccine recovery trade. But even within these, like right now, I think dispersion is very high, and the leadership at the top of the market is somewhat narrow and not quite as strong as it looks altogether. Like, how do these things factor into thinking broadly and thinking about everything all at once? And have you guys observed this as well? I know you could quantify it, and it's definitely true. But how do you feel about that?
I didn't follow. How do I feel about non-equity?
No, about dispersion in markets.
Oh, like, dispersion in
for
markets?
10 years we had it where, like, when stocks went up. But now it's like, you'd have maybe three sectors leading things and everything else lagging, and then, hand it off to different leaders and other things kind of like lose their ground.
Yeah, no, that's true. And that's a fair point. And you're right. I mean, it was kind of unusually correlated for a while there. But I think it all kind of stems from an excess of capital. And I think you're right. It's definitely not just the publicly traded securities markets, equity or anything else for that matter. I mean, you see, in my opinion, a pervasive attitude of gambling and speculation rather than analysis and probabilistic thinking about where things might go. So, and that applies to cryptocurrencies, physical commodities, bank loans. Junk yields are at like an all-time record low right now in corporates. So, I mean, it seems to apply to pretty much everything, I think.
Yeah, the risk taking is definitely we've seen some bizarre stuff this year in particular, right? Going back to January, February, and then more recently, the meme stock phenomenon. I think, John, that relates to your point about a lot more of the world going digital in general. I feel like that lends itself to these kinds of forces.
Yeah, I mean, I just feel like things can run up so much while the fundamentals of it are unresolved, because you can argue one side or the other. Take crypto, right? We don't know if Bitcoin has any value or not. That's going to be clear 10 years from now, probably, maybe much sooner. But in the meantime, because of what's happening in the markets and all the liquidity and all the speculative behavior, you have things like Dogecoin that now looks like the conservative bet compared to Doge's wife, which I just found out a few days ago. I don't know if you guys even saw this.
I had no clue Doge had a wife.
No. There's now a crypto called like Doge's wife, and that crypto has been going up huge.
That's what I mean. Like, what are we? Wow.
So and on the one hand, you want to say volatility is an expression that there's a wide range of potential outcomes. On the other hand, Doge is just a meme anyway.
Yeah, or you take the NFT phenomenon. You can now argue for it or against it. There's not going to be any immediate winner to that argument. So it's just a kind of a function of supply and demand right now. And any price is possible. In the future, it's going to be very clear whether there was any value or not. But I definitely agree with kind of the general sentiment that Phil, you voiced, which is basically people are not really thinking much about the downside right now. They're thinking about what can I get in to make the quick buck, because so many of those things have worked. Anyway, let's move on to Elliot. You've got an interesting one for this week as well.
Okay, yeah. So, I had a really good break from the pod. Did the annual family trip to Lake Placid, as we mentioned. I had some good time to kind of get back to a good reading recipe, which had been basically destroyed when COVID started and the kids were spending a lot more time at home. And, I got to think about a lot of things. I also had a somewhat adverse specific day in the stock market with one of what came into the year as one of my larger positions. And it got me thinking about a lot of things. So on one of our earlier podcasts, I spoke about Kambi and the opportunity in the US sports betting industry. And, at RGA, we first wrote up Kambi in in the fall of 2019. And, it was a position that we had a lot of hope for and thought it was an interesting setup where at the time they hadn't lost DraftKings as a customer, nor had they launched Penn, though they had recently signed what was called a long-term deal with Penn and, Penn Gaming to be specific. And not terribly long after that, DraftKings made it official that they were leaving Kambi as a client. But the way we had underwritten the idea was if they're able to keep DraftKings, it was worth somewhere 275 or up in krona per share. But if they lost DraftKings, it was worth, the high 100s, which at the time it was a stock trading in the 120s and 130s. So that was a pretty good risk reward as we saw it, where even in the most adverse fundamental development they were facing, they'd still be worth more than the stock market price. And I increasingly got convinced they had a good position in the US industry. But, what happened along the way, the stock actually was, obviously one of the things I had contemplated at the time of underwriting the position was they might actually benefit in a recession because states would be more quick to legalize and regulate sports betting. So that would help them achieve their market ambitions quicker rather than slower. And obviously pulling forward the future is a net present value positive. But who would have guessed that the first recession they deal with is when sports have to stop entirely and there is thus no sports betting. But they have, a very low level of fixed costs. They were able to keep some international sports alive, like ping pong, to get some of the, junkier bettors in there and keep the business pumping along. And then sports came back with a vengeance. People were far more focused, betting. More states did, in fact, legalize and regulate. That happened much quicker than I expected. But where I'm going with this is I identified a fundamental flaw in my sell discipline and my process on the sell side. And I need to think a lot more about the contrast between when a position goes from thinking about the underwriting to thinking about position management and what an exit strategy looks like and how to approach that. One thing that was fundamentally true of when, where, and how I underwrote the position, I felt the risk reward was asymmetrically skewed to the positive. So even while I identified, the 170-ish bear case, which was above the stock price, 275-ish upside case, I thought there was a potential for something even better, where they keep DraftKings, Penn realizes their ambition, and the market ends up in a more fragmented end state. And by no means felt this was absolutely necessary, but there was a real asymmetry there. The problem is the stock came into this year on a high note at about 400 krona per share, and the asymmetry actually flipped where the reward was less than the risk. And while I have no hard, fast rule on how I take on positions, what I generally look for is some skew in the reward to risk ratio where I want it to be 3-to-1 or better, where I'm going to be rewarded 3 units for every 1 unit of risk. And then I'll think about, how likely the reward side is versus the risk side to be realized. So the greater the skew is on the likelihood to the reward side, the better the risk reward, the lower an actual reward to risk ratio I'd accept, right? I'd pay more for certainty than I would for high uncertainty. And, I talked about Nick Sleep in one of the episodes, and he had a great quote about how when a business is moving along, you probability weight the branches. And his quote is, we would propose that some businesses, once they have progressed down the first favorable branch, stand a much greater chance of progressing down the second favorable branch, and then the third, as a virtuous feedback loop builds. And I think about this with something like Roku, where the business, as they moved down favorable branches, it opened more doors, increased their power in the industry, gave them more different vectors to explore for monetization. So it actually helped meaningfully increase their addressable market. And Kambi, every bit they moved toward their achievement of ambition. In fact, it did not increase the future potential possibilities. It only was capturing and harvesting what was there in their actual runway. So while the risk reward pendulum had flipped from quite constructive to quite negative, so too did the general potential trajectory that the business would take. And sure enough, as I was thinking about selling, they had a really bad news event where Penn bought a company which effectively gave them a path to building their own tech stack and leaving Kambi. And this was a couple weeks after Mohegan Sun in Connecticut had been bought, not bought in the M&A sense, but FanDuel paid so much damn money that it wouldn't make sense for them to work with Kambi anymore, including FanDuel paying out Kambi for the next few years, which really changed my thesis on how to think about the long tail opportunity in the US. So everything was deboned. And so, I'm really just putting this out there to kind of talk through some of the challenges I have on sell discipline, how to think about it, and this new steadfast rule I have, which is twofold. One is when the probability weighting branches don't improve as the business moves along and achieves some of its ambitions. It's not the kind of thing that you should think about from the position of holding for a very long time. You have to re-underwrite it effectively every step along the way. The other is that when the risk reward pendulum flips, from this reward is greater to risk is greater to reward, no matter what's happening, you have to start exiting the position and trimming it down. You don't have to exit the entirety of the position, but you do have to start trimming it down. And so, I've really internalized these. I've had some time to mull it over. And I think those two hard rules are quite important for me. And I thought it'd be timely and helpful to kind of revisit this topic that I introduced in one of our earliest podcasts. And I'd love to hear, I know we did talk about sell discipline in one of our earlier podcasts as well, but I'd love to hear some of the rules you guys have, some of the ways you've approached these positions, and maybe some war stories from in the trenches about times you've done something that you regretted and how you've internalized some lessons from that.
Yeah, well, there's a lot here. I mean, I'm not close to the company like you are, so in this specific example, I can't chime in on the facts of the case particularly well, but it does strike me that, I guess it just depends as to whether or not the developments that happened in August are a change in the branches of possibility, right? Which I'll come back to that in a second, or whether it's just, that was a temporary setback or an option that would have been really nice to develop, but doesn't change the overall scenario too much. I mean, you still would have more than doubled your money had you bought in at various points along the way in 2020 or even back a few years before that. So, this isn't a total catastrophe, but it does speak to something that I'm always trying to avoid, which is I don't care at all about mark-to-market losses or, what a decline in the quoted price would do in a month or a year, even as it impacts my own results. But what I do care tremendously about is committing capital to something and then having something like this happen where it illuminates a mistake that I made with no chance of recovering it. Right. So if this is still a good business with a, potential long runway ahead of it and favorable economics that can kind of carry it along on the tides, then it wouldn't worry me all that much. I mean, yeah, this would have been unfortunate. And I agree. You have to take note of the fact when the risk reward profile kind of flips and, getting those decisions right and kind of trimming, so to speak. I don't generally like that term because, it comes with consequences, right? You're not just trimming and that's the end of it, right? I mean, there's tax consequences, there's frictional costs. I mean, it's not just a simple one-off decision, but if that's the goal, I mean, it's not as easy as it looks, right? I mean, it's really hard to get those decisions right. And I don't think I'm any good at it in those scenarios. But one way I like to think about it is, and so you'd kind of mentioned this, are either of you guys familiar with the game Plinko? It's like a video, or it's a game that I think originated on The Price is Right, like years and years ago. And now, at least in the US, there's a game called The Wall. It's like my kids watched. It's like a game show on TV. And it basically, I mean, if you Google it or look it up, like you'll see it. It's basically just a ball or a disc or chip that kind of bounces down this giant wall with a bunch of pegs sticking out. And so it's just a giant exercise in randomness and path dependency, right? Because as this thing bounces down through 10 or 20 of these pegs, it has to bounce either left or right as gravity's carrying it downward, right? And so once it bounces left or right, it can't reverse course and go back up and go the other way. And so in Plinko, it's sort of like playing roulette, right? I mean, the odds are stacked a certain way so that the gamester knows what's going to happen over time. But in real life, I mean, I think, Elliot, what you were talking about is exactly the way I think about it, which is that if the ball or the puck starts bouncing left and all of the good outcomes are left, that's enormously important, right? I mean, that's huge, and that's exactly what you want. And then if it starts bouncing to the right and all of the bad outcomes are over there, like, bankruptcy, permanent loss of capital, all that stuff, right? That's all clustered on the one side and it starts bouncing in that direction. That's when you really need to sit up and pay attention. And maybe in the middle is like still a decent outcome, but you start bouncing further away from the good outcomes and you just kind of have to recalibrate, kind of reset your expectations and figure out like, all right, I'm either too big or I was wrong about which way this was going to go. I was wrong about the odds of the ball going left or whatever the case may be. And so that's kind of how I think about it, right? Because you're just trying to get those odds, which are inherently difficult to predict. And you're trying to harness the inherently impossible task of randomness and kind of put it all in your favor. And if you can find companies that do that repeatedly, I mean, we've talked about it as not ad nauseum, but like one good thing seems to pretty much always lead to another good thing at Amazon. Like they systematically find a way to convert expenses into revenue sources on the income statement. And they find ways to monetize assets where it's like a fundamental core part of their operation. And they find a way to turn that into a bigger asset than it already is for them by, rolling it out to other people. So that's the kind of thing you're looking for, right? Whereas like the more nodes you hit, the more pegs you bounce off of, the more awesome opportunities unfold beneath you on the Plinko board. And so it's kind of a crude, crazy little analogy, but I think it's been a helpful way for me to think about it.
Yeah, I would say, if you say I look for stocks that have downside protection, that's a little bit like the 3-to-1 ratio, Elliot, because if there's very little downside, chances are the upside to downside ratio is going to be favorable. It's kind of the Pabrai idea of heads I win, tails I don't lose much. Again, you don't lose much, but you can win big. And I like this idea of kind of moving along with the story and probability weighting the various branches and so forth. I'd love to, hear more about how you do that in practice, Elliot. And a question, Elliot. Another company that you've talked about in the past that worked out incredibly well since you've owned it is Roku. And as that stock went kind of through the stratosphere, how did you think about, kind of the upside to downside ratio there?
Well, yeah, I think they're both related questions. I think on one hand, it's impossible, ex ante to say these are the probabilities and these are the actual trees it could go down, and handicap everything appropriately. You could just think about what is today, but that's part of the dynamic process of following something, forging an initial hypothesis that's testable and managing it along the way, right? It's position management, not position watching in that sense. And I think Roku is a perfect example of that, where when I was starting with the company, they had less scale than Comcast by a decent amount in households. Now they have decently more scale than Comcast in total households that they reach. And so you start thinking about the different levels of leverage they have over content companies, which was a lever they never could pull before. And then they start buying the pieces to kind of build a full stack, from managing advertisers' ads across the landscape to what inevitably will be dynamic insertion in whatever kind of linear people watch through connected TV. Say whatever kind, because it could be credentialed login with your actual linear, or it could be buying something like Hulu TV. And so, each step of the way, you have to dynamically think about how much these new pieces are worth. And, as they achieve certain ambitions, you could factually say that some portion of the risk has been de-risked and start moving forward. And, what was your initial bear case doesn't have to stick as your bear case as you march on. But, I think it's hard. I think it takes a lot of paying close attention. I think there are opportunities where, I think that's one of the reasons why I like thinking about Bayesian weighting on these things, because you don't want to leave yourself too prone to moving with the wind. And there are a lot of times where just market action alone will try to change your mind on certain things. I think I've mentioned the story of Roku dropping the first 15 days I owned it without a single green day. But the follow-up to that is, once it finally was green, it started 2019. I think the first month, its average daily range was upwards of 8%. I've often said something along the lines of volatility is the way of the market grappling with a really wide range of potential outcomes. And so, I think that's part of thinking about these probabilistic branches. How wide is the starting point? Does it narrow? Does the bottom get pulled up? Does the top get pushed up? And in some cases that absolutely can exist. I love your example, Phil, of Amazon and turning every expense into a discrete business opportunity. I mean, who would have thought this is where it's gone? I think Josh Tarasoff had one of the most beautiful theses on Amazon. And I think he sells himself a little short when he says he didn't see exactly where AWS's success was coming from, because he specifically said, there are a lot of bets in this company that I don't know are going on, but this is how you think about how the extent of their bets and how you could kind of think about what return they're able to get on it. But
that's just it, right? You have to put yourself in that position to get lucky, right? I mean, so I think the analysis there can be completely valid, even if it's limited to, this is a good company with the right culture and they're taking a lot of bets where the Plinko board is stacked in their favor. And it doesn't really matter if I predict which way the ball's going to bounce, because, just like your upside downside ratio and a security price, like the upside downside on these bets paying off is just so enormously in their favor. It's sort of like upside margin of safety, right? You just don't even need to make a prediction because all the outcomes are so positively skewed in your favor.
I totally love that Plinko board analogy, by the way. I'd never heard of that. I've heard of the wall. My kids aren't into it yet, but it's so perfect. I think it's 100% true. And,
it's
some
like
people
an old goofy Price is Right thing. It's kind of, like I said, the wall's the new version of it, but it's like a perfect example in randomness and path dependency. And that's probably not what 99.9% of people are thinking about when they watch it, but that's what I thought of.
100%. I think it's awesome. And I think to an extent what you're talking about in finding these companies that have this sort of skew, in financial terms, we'd call it optionality. But I do think there's something truly fundamental to it. Like, you need companies who think that way. I'll give you an example of where it didn't exist. Like, you look at DoorDash's success, you contrast that with where Grubhub went wrong. And it's like, DoorDash was thinking from the beginning about how much broader they could be. And Grubhub was like, we're food. We just want to deliver it. We don't think this other business could ever work. And granted, there's some people who are quite skeptical on DoorDash's ability to make it work. But, you could identify certain cultural traits, certain strategies and tactics that they've taken along the way, and think fundamentally if the business is in a position to even kind of broaden its tentacles. So these are all important questions to ask along the way. That said, it also gets really hard to think about when to sell some of these situations because you don't know if the market's carried away with it. Roku is actually one where I think I've what I'd call traded around it quite well. Not the full position, but portions of it. And, in stocks like this, you could get quite juicy premiums in options markets. So I've used options to kind of like take off risk and extract some principal at different points along the way. But I think position management, sell strategy, all that is like one of the areas I think I personally can improve the most. I see the least written on it. I think, I've talked about some people I know in the past who could position manage their way to money with not a single good idea. So that's one of the areas I'm obsessed with, and I think a lot about. It's also hard when I know, Phil, you similarly aim to hold things for a long time and keep turnover low. So like try to limit the number of decisions we make, right? So that too leads to, if your propensity is toward inaction, when does your threshold for action kick in?
Yeah, it's a tough thing to balance, right? I mean, the fundamental premise there is that if I don't have a lot of great insights, I need to capitalize when I do have one. And I think that just reflects how difficult the world can be, right? I think markets are sufficiently efficient to not offer hundreds and hundreds of bargains at any given time, right? If there were, then the most prudent thing would probably be to diversify into all of them somewhat equally weighted. But, I think it's just logically true that, in a world that's competitive and where good ideas are scarce, you're not going to have your 50th best idea be as good as your 10th best idea. So that's what that is. But you're right. I mean, you can't let that discipline of having a high bar to make any investment be a deterrent from making an investment that's still pretty good, right? You can't let the perfect be the enemy of the good. And you also can't allow things that were good enough at some point, a year ago, 5 years ago, 10 years ago, sit there for too long. So, again, I do believe that cycles still exist. I do believe that capitalism is a force of creative destruction. I do believe that companies come and go. And so it's going to be, the very few top fraction of a percent outliers that persist for decades, where the economics of the business and the returns on capital support that position for 5, 10, 20, 30 years, right? So you have to be aware of that fact that you cannot let any of this turn into dogma and just sit there and let patience turn into being stubborn, which is certainly something I have to watch out for. Yeah,
patience turning into stubborn makes me think of that Munger quote about thumb sucking and how often people do it.
For sure.
Yep. And I do feel like in this case, I was guilty of it because I was leaning towards selling, but I was like, nothing's going to bite me imminently. So I will hold off on this decision because, taxes. I've realized a lot of cap gains this year. So early next year, I'll do my realization. Even if the stock's a little lower, it'll be better. And I think those are like never, ever good reasons to do it. I've said this too many times to count, but like once you come to a decision, that's when you should act on it, not a moment later. Even if even if you hold yourself to a standard of long holding periods or whatever else.
And I think that's true on both sides. I think it's true on the good and the bad. I mean, by nature, I think my do no harm mentality has kept me out of trouble for the most part, right? I mean, I haven't made too many mistakes where I woke up and realized that the analysis was wrong, the math was off, the odds were really way different from what I had calculated. But what it has definitely also caused me to do is sit there for too long and miss opportunities that were good enough and where I knew that they were good enough. And so that is the thumb sucking element of it, right? So I think, and the flip side of this, the thumb sucking part of it on the negative is when you've had something that was good that's clearly gone bad and you sit there for too long. It's like almost a sense of nostalgia, right? Like business or financial nostalgia, where it's like, boy, the good old days of Wells Fargo, I rode that thing for 20 years and it went up 25x or whatever the numbers were. And then, you get hit between the eyes with some evidence that it's just, you're not in Kansas anymore and you don't do anything about it. And you're right. I mean, the right answer is to immediately jump on it when some clear evidence emerges, no matter how painful it is.
I think you could effectively say you go for the left thumb, I go for the right thumb, or something like that, because I definitely skew more toward that latter story.
Yeah, I know what you mean.
But yeah, no, that's exactly right. It's really easy to fall into that trap when you're every time it's been when I'm in something, not when I'm looking at something. And I know the quote about errors of omission greater than commission, whatever. But I think that's a different shade of it that could manifest a lot. And by the way, I think maybe the punchline that I didn't say is that, I sold the whole position the second I heard that news. My thesis was gone. Like, I can't just hang around.
Oh, really?
And try to re-underwrite it. Yeah, I didn't wait a minute. The second the halt ended, it was like, oh, yeah, goodbye. And I have no regrets, no qualms about it. I think that's how, I've avoided a lot of further pains by being very quick to act in situations where it's like that. I know some people might say wait a day or two and see how it settles and how you feel, but I knew exactly the consequence of it immediately. It was something I'd grappled with in advance, like what happens if. So there was no thinking to do. And God, why do I wait for the end to say this? I should have said it right away in the beginning of the section. I
think the key part of it too is that you'd thought about it in advance. I think that's when you really can get tripped up, is when you get blindsided. And so the fact that you'd thought through the scenarios and what the associated probabilities were, and it didn't really matter if it was a 1 in 100 chance or a 1 in 10,000 chance, but it happened. You knew the implications and you knew you had to act, right? I think that's the way to avoid just being your own worst enemy and tripping over yourself when those sorts of things come up.
Yeah, that's a good point. And obviously in every situation, you can't anticipate exactly every range of possibility, right? Like I introduced the idea that I thought a recession would actually be good for them because they'd get more states. And then you have no sports. Who could have anticipated that? I don't think that was in anyone's range of possible outcomes. So I definitely, gave it some deep thought in those moments, which was different than, in this given situation for sure.
Yeah.
I'm curious, Elliot, do you manage the emotional side of it at all? Because let's say the stock's down, you sell it for a good reason, but then it bounces right back up, or goes up a lot after you sold out. There's got to be some kind of psychological component to this. So does that ever figure into the decision?
Yeah, I've certainly had that happen to me. I don't let that figure into the decision. I am somewhat immune to FOMO, which is helpful. Definitely not immune to other behavioral forces, but that's one that I uniquely don't really feel swayed by very often, if at all. And so, I think once I'm out, because I can't stand behind just waiting for something to work if I have no underlying thesis, right? And I think it's far worse, like, I think of that Parcells quote, Bill Parcells, the football coach, I hate to lose more than I love to win. I think emotionally, I'd kick myself way more if I'm like, I want to be out of this thing, but I want it to bounce 15% and then do it, not sell it right there. And then what do you do when it's down 15% from there? Do you say to yourself again, oh, next bounce, I'm going to sell it. And then it keeps going down, and then next bounce. And you fall into this kind of slide. I have this quote that I've used for myself on that, like mistakes beget mistakes. So if you do make that first mistake, you're going to make a lot more mistakes. It's going to take more mind share, and the costs are going to be way more than what you'll actually realize in the loss on the position if you don't get out. So, that's a really good question. It's one I've contended with myself on in the past, but I like to think I'm a Band-Aid ripper. And when I have situations where I got to rip it, sometimes it's going to hurt a lot, but you just got to do it because you don't want to realize the consequences of not doing it.
Yeah, well, the topic of portfolio management is a fascinating one, and I'm sure we'll return to it many times going forward. That notion that a good portfolio manager can take a bunch of bad ideas and still do well, whereas a great analyst can do poorly because he's a bad portfolio manager. That's just really fascinating. I still don't understand how you can make money if all your ideas are bad, but maybe there is a way. I haven't found it.
I didn't say bad ideas. I said the absence of ideas.
Okay, got it.
No ideas, just actions.
Right. Phil, did you want to?
No, I think
something?
it's fascinating, though. I mean, I definitely did not appreciate the kind of magic sauce that a good portfolio manager brings to the table until I got into that role. Right. I think when you, at least at a lot of firms, I think the junior folks are often tasked with generating good ideas, and then they're kind of fed into the machine, and you don't really even sometimes know or have true visibility into what the overall portfolio looks like. And I think it's backwards, right? I mean, I think it helps to have a perfectly flat organization or decision-making structure, but you can't then underestimate how important it is to have that, portfolio mindset, because things do correlate, they interrelate. You can't, I agree. You're obviously not going to do well with all bad ideas, but you're certainly not going to do well with all good ideas with no sense of how they fit together. So.
Well, on that note, thank you guys for a great discussion. Really looking forward to the upcoming season. Take care for now, and we'll reconnect next week.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.